Great. Now that we know what financial management is and the decision involved, let's talk about where businesses get the money to make these decisions, the sources of finance. Just like you might get money from different places for your needs, your salary, a loan from bank, or even pocket money from your parents. Businesses also have various avenues to raise funds. We can broadly categorize sources of finance in few ways based on time period, based on time period, those are long-term sources and short-term sources. Long-term sources, these are funds needed for a longer duration, usually more than 1 year to finance fixed assets like land, building, machinery, what is machinery or long-term projects. Think of it as money for big, lasting investments. Examples include equity shares, preference shares, debentures, long-term loans from banks, and retained earnings. Short-term sources, these funds are needed for a shorter period, typically up to 1 year, to meet working capital requirements like buying raw materials, paying salaries, or covering day-to-day expenses. This is like your monthly budget for immediate needs. Examples include trade credits, bank overdrafts, cash credit, and commercial papers. Based on origin, internal financing and external financing. Internal accruals, these are funds generated from within the business itself. The most common example is retained earnings, which are profits that a company chooses to keep and reinvest rather than redistributing as dividends. It's like using your saving to fund a new project instead of spending it all. External financing. These are funds obtained from outside the business. This includes issuing shares or debentures to the public, taking loans from financial institutions, or receiving credit from suppliers. This is like borrowing money from a bank or getting investment from an outside party. Each source has its own characteristics regarding cost, risk, control, implications, and repayment terms. For instance, issuing equity shares means you don't have to repay the money. It's permanent capital, but you dilute ownership and share future profits. Taking a loan means fixed interest payment and repayment schedules, but you don't dilute ownership. Think of building a house. You will need a long-term loan, mortgage for the house itself. You might need short-term credit from a hardware store for materials you pay for, for in a few weeks. You might use your own savings, internal finance for some upgrades, or you might ask family or friends to invest external finance if you need more capital. Yeah. The question is, a well-established manufacturing company decides to use its accumulated profits from the past 3 years to purchase a new advanced production line that is expected to last for 10 years. Which category of finance best describe this funding decision? So it is expected to last for 10 years. So it is long term and it is internal. So B is the correct option. Yeah. Now we will move towards ratio analysis. So Financial ratios are like diagnostic tools. They are relationships between two or more financial figures taken from a company's financial statement, like the balance sheet and profit and loss statement. They help us evaluate various aspects of the company's, for example, liquidity, solvency, activity or efficiency, profitability, market position. Liquidity, its ability to meet short-term obligation. Solvency means its ability of company to meet long-term obligations. Activity or efficiency is how efficiently it is using its assets. Profitability, its ability to generate profit. Market position, how investors perceive the company. Why are these ratios important for management? To identify strengths and weaknesses and make operational improvements and set future targets. For investor to assess investment opportunities and risks. For creditors or lenders to evaluate the company's ability to repay loans. For competitors to benchmark their performance against industry leaders. It's like looking at the company's report card. A single number on its own might not tell you much, but when you compare it to other numbers like sales to profit or debt to equity, you start getting a clearer picture. Let's briefly look at the main categories: liquidity ratios, solvency ratios, activity ratios, profitability ratios, market ratios. Let's say, let's start from liquidity ratios. This measure a company's ability to pay off its short-term debts. Think, can they pay their bills next month? Current ratios is the ratio of current assets to current liabilities. Quick ratio or asset test ratio is the ratio of current asset minus inventory to current liability. Solvency ratios. This measure, uh, this measure a company's ability to meet its long-term obligations and how much debt it uses to finance assets. In can they pay their long-term loan? Debt to equity ratio, total debt divided by shareholders' equity. Second one is interest coverage ratio, that is EBIT divided by interest expense. Activity or efficiency ratios. This measures how efficiently a company is using its assets to generate sales. Think, are they make are they making the most out of what they have? Inventory turnover ratio, it is cost of goods sold per average inventory. Debtors turnover ratio is the net credit sale per average debtors. Profitability ratios. This measure measure a company's ability to generate earnings relative to its revenue, operating cost, balance sheet assets, or shareholders' equity. Think, how much profit are they making? Gross profit margin, say, minus cost of goods sold per rupee of sale. Net profit margin is a net profit per rupee of sale. Return on investment or ROI or return on capital employed, return on equity. Market ratios. This relate a company's share price to its earnings and book value. They are often used by investors to evaluate the attractiveness of an investment. Think, how is the market valuing this company, like earnings per share, EPS, or price to earnings ratio, dividend payout ratio. Don't worry about memorizing all the formula right now. The key is to understand what each category tells us. We will tell into specific calculation and interpretations in the next step. Does the idea of using ratios to assess a company's health make sense? Would you like to clarify anything about why we use these ratios before we look at specific calculation? Yeah, great. What specifically would you like to clarify about why we use this ratio or their significance? So we will see, we'll see more about efficiency. That's an excellent point to focus on. When we talk about efficiency in financial ratios, we are basically asking how well the company using its assets to generate sales or revenue. Think of it this way. A company invest a lot of money in things like inventory, machinery, or giving credit to customers or collaborators. If these assets are just sitting idle or not being managed well, they are not contributing much to the business. So efficiency ratios help us to see if the company is getting good bang for its buck from its investment. For example, let's consider the inventory turnover ratio. It is cost of goods sold per rupee of inventory. If a company has high inventory turnover ratio, it means they are selling their inventory quickly. This is generally good because it reduces storage cost. It minimizes the risk of inventory becoming obsolete or damaged. It means capital isn't tied up in unsold goods for too long. On the other hand, a very low inventory turnover might suggest that the company has too much inventory or that its sales are slow. It's like having a refrigerator full of food that you never eat. It's costing you money and eventually it might go bad. Similarly, debtors turnover ratio tells us how quickly a company is collecting cash from its credit sales. A higher ratio means they are collecting money faster, which is great for their cash flow. So, in simple terms, efficiency ratios, often called activity ratios, show us how effectively a company is managing its asset to maximize sales and minimize waste. They bridge the gap between what a company owns and how much it sells. Wonderful. I'm glad that's clear. You are doing great grasping these fundamental concepts. Now that we have understand why ratios are important and what they represent, let's get into the practical side, calculating and interpreting them. This is where the real fun begins, as you will start to see how financial statements come alive. To do this, we will need some basic financial information. Let's use a simplified example of a company's balance sheet and income statement or profit and loss statement. Imagine the following for Alpha Company balance sheet as on March 31st, 2025. Current assets have been given, including inventory, current liabilities, total current and total debt, long term, shareholders' equity, total assets. Yeah. So now let's start with the liquidity ratio. Can you calculate the current ratio for Alpha Company? Current ratio is the ratio of current total current asset divided by current liability. When I see current asset, they have given current asset, those are 2 lakhs of rupees and current liability of rupees 1 lakh rupees. So current ratio for Alpha company is 2 lakh divided by 1 lakh, that is 2. Whereas if we find out acid test ratio, it will be 2 lakh minus 80,000 divided by 1 lakh. That would be 1.20. Here it is 2. You're absolutely correct. Current ratio is equal to current asset divided by current liabilities, that is 2. Excellent work. So what does a current ratio of 2 mean for Alpha company? It means that for every rupee, one of current liability, Alpha company has rupee 2 of current asset. This generally indicates a good ability to cover its short-term obligation. Liquidity. A ratio of 2 is to 1 is often considered healthy in many industries. Now, what's good can vary by industry. Would you like to try calculating another ratio, perhaps the quick ratio, or move on? So we'll see one more example of quick ratio. Great. Let's stay with the liquidity ratios for a moment and calculate the quick ratio or acid test ratio for Alpha company. For the same, the example is same, and we are already calculated that is 1.2. Excellent job. You calculated perfectly. Quick ratio is equal to 1.2. And regarding my hint, you were probably thinking that inventory is often the least liquid of current asset. It needs to be sold before it becomes cash. So the quick ratio gives a more stringent view of a company's immediate ability to meet its short-term obligations without relying on selling its stock. A quick ratio of 1 is to 1 or more is generally considered healthy. You are clearly doing very well with calculating these ratios. Before we move on to other types of ratios or our next main topic, do you have any questions about liquidity ratios or the concept of ratio analysis so far? Or would you like to discuss the limitation of ratio analysis? Knowing this limitation is just important as knowing how to calculate them. Let's proceed with limitations of ratio analysis. Absolutely. That's a crucial part of truly understanding ratio analysis. While ratios are powerful tools, they aren't crystal ball or come with several limitations. Just like a doctor wouldn't only rely on blood pressure reading to diagnose a patient, financial analysis shouldn't only rely on ratios. Here are some key limitations. Historical data, inflationary effects, accounting practices or window dressing, lack of industry averages, comparability, qualitative factors ignored, single ratio is not enough, different definition of stance, etc. First is historical data. Ratios are based on past financial statements. While past performance can be indicative, it doesn't guarantee future results. The business environment can change rapidly. It's like trying to predict tomorrow's weather based on yesterday's temperature. Inflationary effects. Financial statements often do not fully account for inflation. Assets recovered at historical cost may understand their true value, making ratios based on these figures misleading. A company's asset might look cheaper than they would be to replace today. Accounting practices or window dressing. Companies can use different accounting policy, depreciation methods, inventory valuations, which can distort ratios and make comparisons difficult. Window dressing involves manipulating financial statements just before reporting to make them look better than they are. Lack of industry averages comparability. Ratios are most meaningful when compared against industry averages or competitors. If such benchmarks aren't available or if the company operates in a multiple diverse industries, interpretation becomes challenging. Also, companies of different sizes or operating in different economic conditions might not be directly comparable. Qualitative factors ignored. Ratios only deal with quantitative data. They don't tell you about the quality of management, employee morale, customer satisfaction, technological advancements, or brand reputation, all of which significantly impact a company's success. Single ratio is not enough. Relying on a single ratio can be misleading. A company might have a good current ratio, but be losing money, poor profitability. A holistic view requires analyzing a set of ratios together, different definitions of terms, sometimes different analysts or textbooks might define current assets or debt slightly differently, leading to variation in ratio calculation. In essence, ratios provide valuable clues or and highlight areas for further investigation, but they should always be interpreted in context with other information, including industry trends, economic conditions, and qualitative aspects of business. Does this help clarify why simply looking at a ratio in isolation might not give you the full picture? Yeah, fantastic. I'm glad the limitation of ratio analysis are clear. It's a sign of a strong analyst who know not just how to use tools, but also their boundaries, limitations. So we have now completed our discussion on financial analysis and planning and ratio analysis. Are you ready to move on to our next major topic, cost of capital? This is fundamental concept that ties directly into those investment decisions we talked about earlier. Yeah, excellent. Let's delve into cost of capital. This concept is super important because it's essentially the hurdle rate that a company's investment must clear to be considered worthwhile. Think about it from a simple perspective. If you borrow money to start a small business, you have to pay interest on that loan, right? That interest is a cost for using that capital. Similarly, if you invest your own savings, you are giving up the potential to earn returns elsewhere. That's a foregone return is also a cost. In financial management, the cost of capital refers to the rate of return that a company must earn on an investment project to maintain its market value and attract new funds. More precisely, it's the weighted average cost of all the different sources of financing a company uses, like debt, preference shares, and equity. Why is this important? Investment appraisals, capital budgeting. This is perhaps its most crucial role. When a company is considering a new project like launching that mobile app we discussed, it needs to know if the project will generate enough returns to cover the cost of the money used to fund it. The cost of a capital acts as a minimum acceptable rate of return for any new investment. If a project's expected return is less than the cost of capital, it's generally not worth pursuing as it would destroy shareholders' value. Financing decisions, understanding the cost associated with different sources of finance helps in making optimal financing decisions. Should the company raise money through debt or equity? Knowing the cost of each helps in choosing the most economical mix. Capital structure decisions. It plays a vital role in determining the ideal mix of debt and equity. It's a capital structure that minimize the overall cost of capital and maximize the firm value. Performance evaluation. It can be used as a benchmark to evaluate the actual performance of projects. In a nutshell, the cost of a capital is like the entry fee or the break-even point for any investment. If an investment cannot generate returns higher than this cost, it's not financially viable for the company and its shareholders. It serves as a vital benchmark for investment appraisal. Thus, this initial definition and its importance, especially as a benchmark for investment appraisal, makes sense to you. We can then dive into the calculate the cost of different individual sources. Okay, wonderful. I'm glad the definition and importance of cost of capital are clear. It's truly a cornerstone concept. Now, let's get into the practical side. Calculating the cost of different sources of finance. Remember, remember, a company usually uses a mix of different funds, and each comes with its own price tag. Oh, we will start the cost of debt. Debt refers to borrowed funds, like debentures or bank loans. The cost of debt is essentially the interest rate the company pays on its borrowings, adjusted for tax benefits. Why tax benefits? Because interest payments are usually tax deductible expenses for a company, which reduces its actual cost. There are two main types of debt we will consider: irredeemable debt, perpetual debt. This is debt that the company does not have to repay, or it has very long maturity period, that is perpetual debentures. For calculation purposes, we assume it lasts forever. The formula for the cost redeemable debt after tax is KD is equal to I into 1 minus T divided by NP, where KD is the cost of irredeemable debt, and I is annual interest payment, where T is equal to corporate tax rate as a decimal, and NP is equal to net proceeds from the issue of debt, that is issue price minus flotation cost. Here we need to understand flotation costs are the expenses incurred when issuing new securities like underwriting fees, brokerage, legal fees, and these reduce the net amount of cash the company actually receives. So redeemable debt, this is a debt that has a specific maturity date, meaning the company has to repay the principal amount at the end of a certain period. Most debentures and term loans fall into this category. Calculating the exact cost of redeemable debt is a bit more involved because considers the future repayment of the principal and is often solved using the yield to maturity concept or an approximation formula. The approximate formula of, for the cost of redeemable debt after tax is KD is equal to I into 1 minus T plus RV minus NP by N divided by RV plus NP by 2. So here RV is the redemption value amount repaid at maturity and N is the number of years to maturity. Other symbols are as defined above. Let's try a simple example for irredeemable date first as it's more straightforward. So here they have given some values and we have to find out. So here, okay. So Alpha company issues 10,000 redeemable debenture of 400 each at par, 100% so interest rate is 10% and corporate tax is 30%. So, so I would be okay. So I would be 10% of 10,000. That is 1,000. So we take 1,000 issues 10,000 debentures. So of rupees 100. So it would be 10,000 into 100. That is 1 million. Okay. So out of 1 million, the 10% of 1 million is 1 lakh. So 1 lakh is the interest rate. So 1 lakh into 0.7. 1 lakh into zero point 0.7 divided by 10 lakh. Okay. So 1 lakh. Okay. So 1 lakh 10 lakh is 1 by 10. 1 by 10 is 1. So it is 7%. Yeah, you got it right. That's excellent. Yeah, I know. Next, do you have any questions about the cost redeemable date? No, I don't have any. Let's move on. Just a second. As we discussed, redeemable date needs to be repaid at maturity. This repayment redemption value impacts the overall cost. Let's use an example to illustrate the approximate formula for the cost of redeemable date. Let's use the okay. Annual interest rate payment, T for break times, and redemption value amount. And this. Now we have to solve this problem. Okay. So 1 lakh, 1,000. No. So these debentures are redeemable at the premium of 5%. After 5 years, they were issued at discount of 2% and provision cost are rupees 1 per debenture and the corporate tax rate is 35%. So basically, we have to do calculation. So Beta Limited issued 1 lakh shares of 10% debentures of rupees 1,100 per each. So yeah, here net proceed we have to find out. So 1,000 share of rupees 100 each minus flotation cost. So it becomes 1 lakh minus for flotation cost. These debentures are redeemed at a premium of 5% after 5 years. So after 5 years, it will be redeemed at a premium of 5%. Okay. They were issued at a discount of 2%, and rotation cost are 1 rupee per debenture. 1 rupee per debenture. So how many debentures they have issued? 1,000. So quotation charge 1,000, and 2% discount is there. So if there is a 2% discount, and quotation cost is 1,000, then it become 8,000 minus 1,000, that is 79,000. So N P is equal to 79,000. Then here they were issued at discount of 2%. Okay. Redeemable at a premium of 5% after 5 years. So we have to take one. So redeemable price is equal to 1 lakh plus 0.5%. 0.95%, which is 1,500,000. So you have to find I1 minus P divided by RP plus NP by 2 plus R minus NP by N. N is 5. Okay, so interest was 12% of 1 lakh. 12% of 1 lakh. 12,000. Corporate tax is 35%. RP minus NP. RP minus NP is 1 lakh 5,000. So this is 21 and 5. So 26,000 divided by 5. 5,200. And this is ratio of them. So 9.4, 8, 184 by 200, 90, 100. So 92,000. It is 92,000. 2,000 into 0.65 plus 1,200 divided by 92,000. This is our answer. We'll just calculate it. 12,000. 12,000 into 0.65 plus 5,200 is equal to divided by 92,000. 1.41. Let's see. Mm, Face value 100. So okay, annual interest is rupees 12 per annum. So 12 is okay. Corporate tax is okay. So debentures are redeemable at 5%. So 105 face value. So it is 105. That is also on discount. We have given 2%. So if you want a discount of 2%, so here I think we have made a mistake. 2%. Oh yeah, mistake. Here we have made a mistake. We take 20% discount. Okay, here we have to take 0.02. So you have to look into the calculation in such a way. So now we'll move to calculation once again. So 1 lakh debentures, 12% interest rate, 100 each. So what is the interest? Interest should be 12 rupees. And now we issued at a discount of 2%. So it is issued at 98. And it is when we redeem with a premium of 5%, we redeem at 105. So 105, how many years after 5 years? So 105 minus 98 by 5 plus corporate tax is 35%. So 0.35 is equal to 3 divided by maybe the average value of this 105 plus 98 by 2. So this 2 by 2. So 12 into 0.65 plus this is 27.5, 7.5 plus this you have to do. This is 203 by 2. That is 1.65. So 12.065. Now move to calculator. Let's see. 12 into 0.65 plus 1.4 divided by 1.5. 100. So this is our interest rate, that is 9.06. Here this it is 97. So written and written and um, electricity 97, 3% or 2%. 2% discount is 2%. Okay, there is a protein cost which we have. Okay, okay, okay. That's okay. So now We'll move forward. Uh, okay, do you get when you perform that final division, double check your decimals and you are so close to the correct answer. Okay, perfect. Let's do that final division. Uh, Great persistent and do you have any questions about the cost redeemable date? What you want to make this like 19 is it? Yeah, like when we this discounted net proceed. Okay, and there is a flotation cost of rupees 1 for every debenture. So this value become 97. Once it become 97, then this calculation get changed. As you can see, this become 101. Now this is 3 and 5, 8, 8 by 5, 2 into 2, 1.6. This become 1.6. And 12 into 0.65, that is 7.8. So it become 7.8 plus 1.6, 1 not 1, that is 9.4 by 1 not 1. So this calculation finally comes to a, and that is approximately 9.2%. Okay, so now we will start with preference shares. Cost of Here we will see the cost of preference shares. Preference shares are a hybrid form of financing, meaning they have characteristic of both debt and equity. Like debt, they usually carry a fixed dividend rate, but like equity, these dividends are paid after after interest to debentures holder, but before dividends to equity shareholder. A key difference from debt is that preference dividends are generally non-tax deductible. They are non-tax deductible, whereas interest on debt are tax deductible. For the company, this means there's no tax shield like there is with interest on debt. So similar to debt, preference shares can be irredeemable, perpetual, or redeemable. Cost of irredeemable preference shares, (KP). This is for preference shares that are not repaid by the company. The formula is KP is equal to PD by NP, where PD is the annual preference dividend and NP is the net proceeds from the issue of preference shares, that is issue price minus flotation cost. Okay, so dividend by net proceeds. Cost redeemable preference shares, if they are redeemable, the same formula. Just instead of I into 1 minus T, there is a preference dividend plus RV minus NP by N divided by RV plus NP by 2. PD is equal to annual preference dividend. And redemption value and net proceeds from the issue of preference share, same, and N for number of years to maturity. Now, can you calculate the cost of irredeemable preference share? Yeah. Now, here 5,000, 9% irredeemable preference shares of rupees 1 lakh. So it become 100. So it become 5 lakh, 5 lakh, 9%. 5 lakhs, 9%, that is 45,000. 45,000, and they are issued at par, and flotation cost was of rupees 2 per share. So here we can see it should be divided by 45,000. We have to divide it by 98. So 45,000 divided by 98. 98 into 8,000. So 9 divided by 98, 9 divided by 98. So that is into 100, 9.18 percentage. 9.1836. Yeah, you are absolutely right. That's a precise calculation. Let's break it down. Yeah, I got it. So now we will start with cost ready to move on and more involved calculation on redeemable preference shares. So we will solve the problem of redeemable preference shares now. So Delta issues 2000 preference shares. So they have issues 2000 preference shares. 11% and 100 each. 11% is in a dividend rate and 100 is per rupees 100 is per preference share. Okay. Is there any quotation cost or risk premium that we have to this redeemable share? These shares are redeemable at par, which 100 rupees of share at 100 rupees only. But they are issued at a premium. But during issuance, it they were issued at a premium of 5%, and the flotation cost are 3 rupee per share. So here calculation, the they have they were issued at 105 and flotation cost per share was 3 rupees. So their issuance that's net process is 102, but their uh, redeemable value is 100 because it is redeemed at par value. So this average is 101. So we got denominator. For numerator, we have this is 11% of 100, that is 1.1. No, that is 11. That is 11. And difference between the two and the numbers for 7 years. So it is 11 plus 2 by 7 divided by 1 not 101 into 100. By 7 is equal to this plus 81 divided by 101 is equal to into 100. So it's expensive because of 11.17%. Fantastic. You got it right again. That's a strong demonstration of your understanding. Not understanding, it's a demonstration. Okay. And do you have any questions about this calculation, or would you like to move on to the cost of equity? Yes, we have to move to cost of equity. Yes, yes, move on. It's not working. Fantastic. Now we arrive at the cost of equity, that is KE, most important part. Now, which is arguably the most complex and debated component of the cost of capital, but incredibly important. Why is it complex? Because unlike debt, where interest is clear cost, and preference dividends, where dividends are generally fixed, the cost of equity isn't contractual payment. Equity holders, the owners, expect a return on their investment in the form of dividends and or an increase in the share price. This expected return is the company's cost of using equity capital. The cost of equity represents the return required by equity investors to compensate them for the risk they undertake for investing in the company. If the company doesn't generate at least this much return, investor might sell their shares, driving down the share price and destroying shareholders' wealth. There are several models to estimate the cost of equity. We will look at the common ones. Dividend. First one is dividend discount model, that is DPM, or dividend price approach. So this model assumes that uh, the value of a share is the present value of its future dividend. The value of the share is the present value of its future dividends. It's often used for companies that pay consistent dividends. For constant dividend and no growth. The two assumptions are there, that there is no growth, and first one is there is no growth, and second one is constant dividend. In that case, K is equal to D1 by P naught, where D1 is the expected dividend per share at the end of year one, or current dividend if no growth expected. It is a current dividend with no growth expected. Or we can say it is the dividend per share at the end of the year one. Second one is P naught, that is current market price per share, current market price. Net proceeds if new issue considering protection cost, and we have to take consider net proceeds if new issue, new shares have been issued, and considering the flotation cost and decreasing the flotation cost. So for constant growth in dividend, there is a Jordan's model, that is D1 by P naught plus G. And for G, we have formula uh, that is, first we will see what is where D1 means. It is the expected dividend per share at the end of year one. Here it was expected dividend, the same one. And it is D naught into 1 plus G. It is D naught into 1 plus G. If D naught is current dividend, so here we have taken current dividend considering there is no growth expected. So it becomes D naught. In case of constant dividend, D1 has become equal to D naught. But if when we say there is a growth, then D1 will become D naught plus 1 plus G. And it is the expected dividend per share at the end of year one. So if D naught is a current dividend, then D1 is equal to D naught into 1 plus G. And P naught is a current market price per share. And net proceed if new share issue considering rotation cost, and G is the constant growth rate of dividends. Okay. Now, remember that if a flotation costs are involved for new equity issues, P naught in this formula would be replaced by NP, net proceed per share. Okay. Flotation cost are involved in the new equity issue, then P naught in this formula would be replaced by NP, net proceed per share. Okay. Capital asset pricing model, that is CAPM. CAPM. This is widely used model that links required return on an equity share to its systematic risk, that is non-diversifiable risk, that says K is equal to RF plus beta into RM minus RF. So CAPM model say that is K, that is the cost of equity, is the sum of the risk, the rate of return, and beta times of a measure of beta times of expected return minus the rate of free return, risk-free rate of return, that is market risk premium. So beta times of market risk premium. So here, what is beta that we need to understand? Before that, RF is a risk-free rate of return, that's the return on government bond. Whatever be the case, we will get this much of return, that is risk-free return, rate of return. And beta is some measure of stocks volatility relative to overall market. So the beta will show the stock volatility compared to overall market. If market goes increment by 2%, then if the stock also increased by 2%, then it is in parallel with market. So in that case, beta would be 1. But if market change by 2%, change by 2%, the stock price change by 3%, in that case, it is 1.5. And if market change by 2% and stock uh, change by 1%, then it is beta would be 0.5. Okay. So beta 1 means the stock moves with the market. Beta greater than 1 means it is more volatile, and less than 1 means it's less volatile. So generally, FMCG stocks are less volatile, and those are Hindustan Unilever, Britannia, Dabur, ITC, etc. And RM is the expected return on market portfolio. So RM is the expected return, and RF is a rate of return. Okay, now let's start. Earnings yield method, that is E by P ratio method. This is a simpler approach often used when companies retain most of their earnings and don't pay significant dividends. And it's based on the idea that investors are buying earnings. So here we have to learn that method is the E by P ratio method, where this is simpler approach often used when companies retain most of their earnings and don't pay significant dividends. It's not like mm, they take complete earnings. Most of the earnings they retain and don't pay significant dividends and use insignificant dividends. It's based on the idea that investors are buying earnings. So investors are buying earnings. So K is equal to EPS, earning per share, divided by current market price per share. So that is the first one. So EPS 1, expected earnings per share for the next period. Expected earnings per share for the next period, and P naught is the current market price per share. This method is quite simplistic and generally assumes all earnings are paid out as dividends, which is rarely the case. Rarely case, huh? Let's start with the dividend discount model, that is a constant growth model, as it's very common scenario. Epsilon company just paid a dividend T naught of rupees 5 per share. So on the dividend is expected to grow at a constant rate of 6%. So what is the D1 here? It is 5 plus 5 into 6%. So it is 5 plus 1.06. So it is 5 into 1.06. So it is 5.3 divided by P naught. So what is P naught here? P naught is equal to 100. P naught is equal to 100. Repeater 100 is equal to into 100. Rather than 5.3%. It's a 5.3%. You are very close. Yes, I have made mistake. Yeah, you have correctly identified the expected dividend for the next year. Yeah, you are correct. So, however, remember the full formula of the constant growth dividend discount model is K is equal to D1 plus P naught plus G. So here we have to understand this is not only D1 by P naught, they have added plus G also. And how about here? It is 3% and 6%, so it is 11%. Also, I have to add growth also. So 5.3% is the cost plus that formula cost of 6, that is 11. 5.0 is 11.3%. Okay, that's absolutely right. And which model that you have used? That model is epsilon naught. The constant growth TTM model. That's the first one, which is dividend discount model. Which one? Dividend constant growth in dividend. It's a Jordan's model. Whatever. Jordan's model. Okay. Now, so we will solve the problem of Kaplan model. That is RF plus beta into market premium. Okay. So Zeta company is analyzing its cost of equity using Kaplan model, where current risk is 7%, market expected return is 15%. So 7 expected return. Beta is 1.2. So we have to find, so 7% is market. So expected return is 15. Expected return is 15 and risk rate is 7. So it becomes 8 and beta is 1.2%. Beta is 1.2. So this is 9.6. Market premium is 9.6 and the risk rate of return is 7. So we have to, the cost of equity is 16.6. So 16.6. Absolutely spot on. That's excellent. Here's the calculation for. Yeah, yeah, yeah. So you have successfully applied the CAPM to calculate the cost of equity This means that the investor in cheetah company, alphabetic gamma, cheetah, alphabetic gamma, that's not cheetah, wrong. Would expect a return of 16.6% on their investment given the risk-free rate, market risk, and company-specific systematic risk data. We You have now covered all the major individual components of the cost of capital, including debt, preference shares, and equity, using both TTM and CAPM model models. Do you have any question about cost of equity or any of the individual cost calculations we have done so far? Or are you ready to move on the understanding the calculating the weighted average cost of capital, that is WACC, which brings all these individual costs together? Yeah, let's learn. Let's learn. Fantastic. Now that you are a pro at calculating the cost of individual sources of finance, it's time to bring it all together with the weighted average cost of capital WACC. This is a super important concept because it represents the overall average rate of return a company must earn on its existing asset base to satisfy its capital providers, both debt holders and equity holders. Think of it like this: if you borrowed money from a bank at 8% and from a friend 5% at 5%, and you use different amounts from each. Now, your average cost of borrowing would depend on how much you took from each. For example, that is exactly that for a company. The WACC is average rate of return required by the company's investor, that is shareholders or lenders. So it is weighted because each component cost is weighted by its proportional share in the company's capital structure. Okay, so uh, weight of debt into cost of debt, weight of preference into cost of preference plus weight of equity into cost of equity. That gives you the fact. So WD is a weight of debt, KD is a cost of debt. Now here's something that you need to understand. Weight of debt in the capital structure in the market value of debt divided by total market value of capital. Okay. Similarly, weight of preference shares, cost of preference share, weight of equity, and cost of equity. Important points that we need to consider over here. Those are marginal cost of capital. WACC is often used as the discount rate for evaluating new investment project. So WACC is often used as the discount rate for evaluating the new investment project for capital budgeting. When a company raises new capital, the cost of that additional capital is called the marginal cost of capital. When a company raises new capital, then the cost of that additional capital is called marginal cost of capital. For decision-making purposes, we are using usually interest rate in the marginal rate. Optimal capital structure. Companies aim to find a capital structure that is mix of debt, preference, and equity that minimize their value, as this ideally maximizes the firm's value or market values versus book values. For WACC calculation, it's generally preferred to use market values of debt, preference shares, equity rather than their book values because market values reflects the current economic reality. Let's work through an example to calculate WACC. Here, XYZ Limited has the following capital structure and cost. Here, the source of capital for this is so we have to solve this one. So the she's total and the So how can you solve this? It's simple. What you have to do, Archie, 15%, total observation, total 1400, 800 for 15%, 200 for 10%, and 400 for 6%. So 200 for 10% and 400 for 6 months. So 164 by 1400. 200. So it is 21.71. You have calculated the WACC perfectly. Okay. So do you have any questions about WACC and would you like to discuss the concept of marginal cost of capital? Uh, Marginal cost of capital. Excellent choice. Delve into the marginal cost of capital, that is MCC. It's a subtle but important distinction from the average WACC we just calculated. While WACC represents the average cost of all capital a company has raised to date, uh, the marginal cost of capital refers to the cost of raising an additional rupee of new capital. A marginal cost of capital refers to the cost of raising an additional rupee of new capital. So think of it in this way. Like imagine you are buying pizza for a party. If you buy one pizza, it costs rupees 300. If you buy second pizza, maybe the store gives you slight discount. So the marginal cost of that second pizza is 280. So if you buy the 10th pizza, they might charge you a lot more because they are running out of ingredients. So the marginal cost could be higher. Similarly, a company can usually raise a certain amount of capital at a particular fact. However, as it needs to raise more and more capital, the cost of that additional capital might increase it. This happens for a few reasons. For example, one is increased risk for lenders as a company takes on more debt. Its financial risk increases. Lenders might demand a higher interest rate on new loans to compensate for this increased risk. Second is dilution for equity holders. Issuing a very large amount of new equity might dilute the existing shareholders' ownership more significantly, making it harder to attract new equity at the same cost. Breakpoints. Often a company A company's sources of finance have breakpoint, for instance, breakpoints. Often a company's sources of finance have breakpoints. For instance, a bank might offer a certain interest rate up to a loan amount of rupees 50 crores, but for anything above that, the rate might jump. Or a company might exhaust its cheaper source of retained earning and have to issue new and more expensive equity. Why is MCC important? In capital budgeting decisions, companies should ideally use the marginal cost of capital as the discount rate to evaluate new projects. Why? Because new projects will be financed with a new capital, and it's the cost of that new capital that matters for the viability of the new project. So the relationship between VAT and MCC. So initially, VAT and MAC might be very close, especially if the company isn't raising vast amount of new capital beyond its typical operations. However, as the firm's needs for capital increases beyond certain threshold, that is breakpoints, the MCC will typically begin to rise. So the optimal investment level for a firms occurs where the marginal efficiency of the capital, the return from additional investment equals to the marginal cost of capital, where the marginal efficiency of capital, the return from additional investment equals to the marginal cost of capital. Thus, the concept of marginal cost of capital and its distinction from that makes sense. Yeah. Would you like to like an example to illustrate that? Yeah. Uh, Great. Let's illustrate marginal cost of capital with an example. It often involves breaking points where the cost of particular source of finance changes. Scenario: Alpha company needs to raise new capital for an expansion project. They maintain a debt to equity ratio of 1 is to 2, meaning for every rupee 1 of debt, they use rupee 2 of equity. Here are the cost of their sources of finance. First one is cost of debt, that is KD. Second one is cost of equity, that is KE. The questions here: what is Alpha Company's marginal cost of capital if they need to raise a total of rupees 180 lakhs for a new project. So here we have to understand basically up to 50 lakh KD is 7%. Above 50 lakhs KD become 9%. And up to 100 lakhs K is equal to 12%. And about 100 lakhs of equity K becomes 14%. Now we have to understand over here what uh, what is the alpha company's marginal cost of capital if they need to raise a total of rupees 180 lakhs for new project. To determine the breakpoint for total capital, since the debt to equity ratio is 1 is to 2 for every rupee 1 of debt, there's rupee 2 of equity, making total capital rupees 3. So determine the breakpoint for total capital. Since the debt to equity ratio is 1 is to 2, they have mentioned in the scenario that the debt to equity ratio is 1 is to 2. So so we have to find out first where is the breakpoint. When, when we get that thing like at the date breakpoint is 50 lakh and equity breakpoint is 100 lakh. So 50 lakh date corresponds to rupees 50 into 2 is to 1, that is 100 lakh equity. Okay, making total capital of 150 lakh. And when equity breakpoint, we consider when date will be that date becomes 50 lakh, half of the equity, and then the making total capital is 150 lakh. So that note the example both in the example both sources have their first breakpoint at the same total capital level of rupees 150 lakhs. Now identify the capital needed beyond the first breakpoint since Alpha company rupees 180 lakh needs rupees 180 lakh and the first breakpoint is 150 lakh. So they need that additional 30 lakh rupees capital after the breakpoint. To calculate the VAT for the capital for after the breakpoint for 30 lakh. And so here we calculate for 30 lakh. That is, so in 30 lakh, we have to understand the proportion of equity and debt. So up to 30 lakh, what is the proportion of 30 lakhs will be of debt? So of debt, we have taken debt of 50 lakh and equity 100 lakh up to 150 lakh. Then when we going to take 30 lakh of debt, in this 30 lakh, 10 lakh will be debt and 20 lakh will be equity. Let me add one more page. So here, uh, the additional 30 lakh, 10 lakh will be debt and 20 lakh will be equity. And the rate will be changed when the thresholds have been crossed. Interest rate will be changed. Those are one is 9% and another one is 14%. So this become 9% and this equity one will become 14%. So for 10 lakh, it will take 9% and 20 lakh, it will take 14%. And this whole become 30 lakh. So it took lakh gila into 900 plus 20 into 14 by 100 divided by 30 into 100. So this 100 will be cancelled for interest rate. So this become 90 plus this 280 divided by 30. So we have to do, and here is 37 lakhs. So it becomes 37 by 3. 37 divided by 3, 12.33%. Mhm. Yeah, so you have got it that precisely the marginal cost of capital for the funds raised beyond rupees 150 lakh breakpoint. Excellent work. Ta-da. Yeah, push. Now we will learn do you have any further question about cost of capital, WACC or MCC? Or are you ready to move on to our next major topic, that is capital budgeting decision? This is where we learn how to evaluate those investment projects we have been talking about. चलो, capital budgeting, capital budgeting. Let's move to capital. So, excellent. Let's dive into capital budgeting decision. This is where the rubber hits the road, as it's all about making those critical investment decisions we touch upon in our very first discussion. So, what is capital budgeting? At its core, capital budgeting is the process that companies use to evaluate and select major investment projects. These are usually long-term investments that involve significant outlays of funds and are expected to generate benefits over several years. Think of buying new machinery. Let me drink water. So, capital budgeting is the process that companies use to evaluate and select major investment projects. These are usually long-term investments that involve significant outlays of funds and are expected to generate benefits over several years. Think of buying a new machinery, constructing a new factory, expanding into a new product line, or undertaking a large research and development project. Why is this process so significant? Long-term implication, irreversibility, large outlays, impact on shareholders' wealth. Long-term implications, capital budgeting decisions have long-term effects on the firm's profitability, risk, and overall strategic direction. Once a large investment is made, like building a factory, it's very difficult or costly to reverse. Irreversibility. Many capital investments are largely irreversible once made. That's the truth. That's harsh truth. Large outlays. These projects often require substantial financial commitments and making it crucial to get them right. Large outlays. These projects often require substantial financial commitments, making it crucial to get them right. So, large outlays. Then, impact on shareholders' wealth. Ultimately, good capital budgeting decisions enhance shareholders' wealth by generating returns greater than the cost of capital, while poor decision can destroy it. This directly ties back to our primary objective of financial management, that is wealth maximizing. Okay, the stages of capital budgeting. Now, this is interesting. Capital budgeting isn't just about crunching numbers, it's a structured process. Generation of investment proposal. So ideas for new projects can come from anywhere within the organization, either from production, marketing, R&D, etc. Evaluation of proposals. This is the analytical heart of capital budgeting. Here, various techniques which we will learn about next are used to assess the financial viability and attractiveness of each proposal. So, two things that we need to assess, that is, first one is financial viability, and second one is attractiveness of proposal. This is where concepts like cash flows, discount rates like back, and risk analysis come into play. Selection of projects based on the evaluation, the most promising projects are chosen, keeping in mind the company's financial resources and strategic goals. Sometimes a company might have to choose between mutually exclusive projects. Only one can be selected, and rank projects under capital rationing limited when there is a limited fund. So selection of project is the third step of capital budgeting. Implementation of project. Once selected, the projects are put into action. This involves securing funds, acquiring assets, and managing the project effectively. Performance review, post audit. This is a critical but often overlooked stage. After a project is completed and operational, its actual performance is compared against the initial projections. This helps identify deviations, learn from mistakes, improve future capital, improve future capital budgeting decisions, and it's like checking if your diet plan actually lead the weight loss you expected. Does this initial overview of capital budgeting and its importance resonate with you? Do you have any questions about what capital budgeting entails before we jump into the different techniques used to evaluate this project? We have to, okay, so let's jump. All right, let's jump right into the exciting part, the techniques used in capital budgeting. We will start with the traditional capital budgeting techniques. These methods are generally simpler to understand and calculate, but they have some significant drawbacks compared to the modern techniques of capital budgeting we will cover later. However, they are still used by some companies for preliminary screening or as a quick check. The two main traditional techniques are payback period and in accounting rate of return, average rate of return, or return on investment. Okay, first one is payback period. So PBP concept. This is simplest and most intuitive method. It calculates the time it takes for a project's cumulative cash inflows to equal to the initial investment. What it does? This is the simplest and most intuitive method. It calculates the time it takes for a project's cumulative cash inflows to equal the initial investment. In other words, how quickly does the project pay back its original cost? That is payback period. Decision rule. Projects with shorter payback periods are generally preferred. We want cash in hand. So a project is accepted if its payback period is less than predetermined maximum payback period set by management. Okay. Advantages. Easy to understand and calculate. Reverse projects that generate quick returns and which is good for liquidity and risk management, especially for firms facing cash flows problems. Disadvantage. Ignores time value of money. It doesn't discuss the time value of money. So it ignores time value of money. This is the major flaw. It treats cash flows received in year one and the same as the cash flows received in year five, even though money today is worth more than money tomorrow. Ignores cash flows after payback period. It completely discards the cash flow generated after payback period. For example, a project might have long payback period but generate huge profit later, which PBP wouldn't consider, does not directly relate to maximizing shareholders' wealth. That is ultimate aim of a financial management. It not directly relate to the maximizing shareholder wealth. Now, accounting rate of return, that is ARR, that is average rate of return, ARR, or return on investment, that is ROI concept. This method measures the average annual accounting profit generated by a project as a percentage of the initial or average investment. So this method measures the average annual accounting profit generated by a project as a percentage of initial or average investment. It uses accounting profits after depreciation and tax rather than cash flows. Decision rule: projects with ARR greater than a predetermined target rate are accepted with the comparing projects. The one with a higher ARR is preferred. So formula, that is a common variation. ARR is equal to average annual accounting profit after tax divided by initial investment into 100. Sometimes average investment is used in the denominator, which is initial investment plus salvage value divided by 2. So here we consider the salvage value. Okay, that's you're taking the how we get that. So advantages: easy to understand and calculate as it uses familiar accounting profits, considers the entire life of the project. Disadvantage: ignores time element. Just like payback period method, it fails to consider the time value of money, using accounting profit instead of cash flows. Financial decisions should ideally be based on cash flows, not accounting profits, as profit doesn't always mean cash in hand, does not directly relate to the maximizing shareholders' wealth. Let's try a quick example for payback period scenario. A project requires an initial investment of rupees 5 lakh. It is expected to generate annual cash flow of rupees 150 lakh for next 5 years. What is the payback period? So the project requires initial investment of rupees 5 lakh. So initial investment we have 5 lakh. For getting 5 lakh, it will require for within a year. After that, so it take uh, 3 lakh. So in 2 years, 3 lakh. 3 years, uh, 4.5 lakh. 50,000 quarter. No, 4 months. So 3 year, 4 months. Absolutely correct. Excellent calculation. Here's how we get there. Okay. Do you have any questions about payback period or advantages and disadvantages? So would you like to try an example for ARR? Yes, ARR. Let's calculate the accounting rate of return, ARR. And remember, this method focuses on accounting profit rather than cash flows. Here's the scenario. A project requires an initial investment of 6 lakh. It is expected to generate annual profit before depreciation and tax of rupees 2 lakh for 4 years. The project has no salvage value. The depreciation is on straight line basis and the tax rate is 30%. So to calculate the ARR, you will need to find average annual accounting profit after tax. So we will solve this problem. Initial investment is 6 lakh rupees. Is there any salvage value? Project has no salvage value. Okay, ठीक है. They expected to generate the annual profit before depreciation and tax. So it is 2 lakh for 4 year. 2 lakh for 4 year. Tax is 30%. So 2 lakh for 4 year. Tax rate is 30%. 30%. Okay. So this is fine. So 50,000. This one, so divided by 35. It is we have put this per year. The investment is 6 lakh. We have divided by 6 lakh. This become 535. You will divided by 450,000 into 1,000. Divided by 1,000. No, become 1 more zero. Become 50. Which is 35 divided by 6 lakh. So 35 for 6 lakh. 5.83%. Um, I think so. 6. If you have, I think I have a mistake somewhere. Let me check. We have not considered the factor that is depreciation. So here in the question, they have mentioned before depreciation. So straight line matrix for depreciation is 6 lakh. Non salvage value for it is for 4 year. So 1,50,000. That is the depreciation. So when I say and profit is expected to generate annual profit is 2 lakh. So out of that 1,50,000 is okay. One point this machine annual profit is so out of 2 lakh rupees which we generate annually 1,50,000 is depreciation. So annually it generates 50 lakh of equity profit, and out of that, three, 30% is the tax. So 15% is tax. So 35,000 is the mm, annual profit that it is generating. And for the annual value, and how do you invest? Is our investment is 6 lakh. Mm, which is right. My mistake. So depreciation is there. We have taken one profit before tax. We have taken 15 of 30% on PBT, right? And 6 lakhs. So it's just 5.83. Okay. Now, we will. These are generally preferred for robots. Now, do you have any question on ARR? No. So we have covered traditional method. Now we will move towards modern methods of capital budgeting. Now we will see modern methods of capital budgeting. Fantastic. This is where capital budgeting gets really powerful because these methods address the main shortcomings of the traditional ones. They explicitly incorporate the time value of money. So, what is the time value of money? Before we dive into the methods, let's quickly recap time value of money. It's a core financial concept that simply states a rupee today is worth more than a rupee tomorrow. A rupee today is worth more than a rupee tomorrow. Why? Earnings capacity, money today can be invested to earn a return, interest, or profit, so it will grow into a larger sum in the future. Inflation. The purchasing power of a money tends to decrease over time due to inflation. Third one is risk or uncertainty. There's always a risk that you might not receive the money in the future. The risk or uncertainty. If once money goes from your hand, there is no chance that it will come back or not. This is a risk. Second one, inflation. Inflation, that money tends to decrease over time due to inflation. Yeah, the purchasing power of the money tends to decrease. Nothing. Earning capacity. Money today can be invested to earn a return, interest, or profit, so it will grow into a larger sum in the future. Yes. So modern capital budgeting technique use discounting to convert future cash flows into their present value. That is PV, and present future cash flow as FP, allowing for a fair comparison with the initial investment made today, and the discount rate used is typically the company's cost of capital, as we just learned. Okay. So Modern capital budgeting technique. Modern capital budgeting technique use discounting to convert future cash flows into their present value, allowing for a fair comparison with the initial investment made today. The discount rate used is typically the company's cost of capital, that is WACC, as we just learned. Now let's explore the key modern technique, that is net present value, NPV, and NPV is the difference. Wait a second. NPV is the difference between the present value of all cash inflows generated by a project and the present value of all cash outflows, including the initial investment. It measures the net value added to the firm by undertaking the project. So it is simply the initial uh, of the future and the present value of all future cash outflows minus the present value of all future cash inflows minus initial investment. Present value of initial cash outflow. That is the formula here. It is a summation from t tends to 1 to n CFT divided by 1 plus r power raised to the power t minus initial investment. CFT is equal to cash flow in year t and R is equal to discount rate, usually the cost of capital that is back, and T is equal to time period, N is equal to project life. Decision rule. If NPV is greater than zero, accept the project. Thumbs up, accept the project. It means the project is expected to generate returns higher than the cost of capital, thereby increasing shareholder wealth. If NPV is less than zero, reject the project. It means comes down. It means the project will not cover its cost of capital and will destroy shareholder wealth. If NPV is equal to zero, indifferent, the project just covers its cost of capital. Advantages. Consider the time value of money. Considers all cash flows over the project's life. Directly relates to the shareholder wealth maximization. A positive NPV adds value, provides a clear monetary value of the project's work. Disadvantages require an estimate of the discount rate, that is cost of capital, estimate that estimated discount rate, that whatever we take that discount rate, it is a estimated one. So estimate professional. Mhm. So may be difficult to compare projects of vastly different sizes. A project with higher NPV might require a much larger initial investment. So may be difficult to compare projects of vastly different sizes. A project with higher NPV might require much larger initial investment. Okay. Internal rate of return. The concept, the internal rate of return is the discount rate that makes the net present value. IRR is the discount rate that makes the net present value (NPV) of all cash flows from a particular project equal to zero. In similar terms, it's the effective rate of return that the project is expected to yield. Calculation cannot be directly calculated with a simple formula. It's found through trial and error or by using financial calculators or software. So if you find the discount rate at which the present value of cash inflows equals the initial investment. The decision rule. If IRR is greater than capital of cost of capital or hurdle rate, then thumbs up, accept the project. And the project's expected return is higher than the minimum required return. If IRR is less than cost of capital or hurdle rate, then reject the project and start. If IRR is equal to cost of capital, indifferent. Advantages considers the time value of money. So here we have it is it consider time value of money, consider all cash flows, provides a percentage return, which is intu- intuitively appealing and easy for managers to understand and compare against a hurdle rate. So here the part of percentage from because we are finding internal rate of return. It is a percentage one. Okay, it's in terms of percentage, where in the case of net present value, it is a value, and here it is a rate. So here we are getting a percent. So in terms of percent, it is equals percentage, and that which is intuitively appealing and easy for managers to understand and compare against hurdle rate. Okay. Disadvantages as in reinvestment of intermediate cash flows at the IRR, which might not be realistic, can lead to multiple IRRs for projects with unconventional cash flow pattern, alternating, alternating between positive and negative cash flows may not provide consistent ranking with NPV for mutually exclusive projects of different scales. So there are three disadvantages. It assumes reinvestment of intermediate cash flows at the IRR, which might not be realistic and can lead to multiple IRRs for projects with unconventional cash flow patterns alternating between positive and negative cash flows may not provide consistent ranking with NPV for mutually exclusive projects of different scales. Profitability Index PI, benefit cost ratio concept PI, that is profitability index or benefit cost ratio, is the ratio of the present value of future cash inflows to the initial investment or present value of cash outflow. So it indicates the present value benefit per rupee of investment. For example, if I take present value of all future cash inflows and divided it by initial investments, so I get the profitability index and the benefit cost ratio. So if this P1 is greater than 1, then thumbs up, accept the project. If less than 1, thumbs down, reject the project. And if Pi is equal to 1, indifferent equal to 1. So advantages. Consider time value of money. Yeah. Consider all cash flow. Yes. Useful for ranking projects when capital is ration. So when a firm has a limited funds and must choose among several acceptable projects, it helps select projects that maximize value per rupee invested. Okay. Disadvantages requires calculation of NPV first and does not give the absolute value of value addition like NPV. So NPV gives absolute value, and this profitability index gives percentage value. So this is disadvantage of what we can calculate both. So few that was a lot of theory, but these are really the workhorse tools of capital budget. Ready to try calculating net profit. Yes. Yeah. So now we'll see problems on capital budgeting. The first one is here. Initial Energita Manufacturing is considering a new project with the following details. Initial investment at zero this month. First year. Mm, okay, okay, okay. Discounted is 10. Mm, Initial investment is 3 lakh. Cost of capital is 10%. Okay, let's solve the problem. Initially, we invested 3 lakh. Zero clear. 1, 2, 3, 4. 1, 1.2, 1.5, 18. 1, 1.2, 1.5, 18. Right, right. So, and then 10% equal 10. So there is no zero flag because it is common. So 3, 1, 1.2, 1.5, 0.8. Okay, it will be 3. We will draw the present value. Okay, this is 1, 1 divided by 1.1, then 2 divided by 1.1 square, then is 1.2 divided by 1.5 divided by 1.1 cube, and 0.8 divided by 1.1 raised to 4. Okay, so this is my present value of all cash outgoes. Investment is investment is 3. So what we do, not calculate this one. 1 divided by 1.1, that is 0.909. 1.2 divided by 1.21, that is 0.9917. 9917. This is then I do 1.5 into divided by 1.331, which is 1.1269. And third one is 0.8. Third one is 0.8 divided by 1, 4, 1, 6, 1, 4, 6, 4, 1. That is two. This is bigger one, which is 0.0000. Nothing is insignificant. 0.000. One lakh, lakh, it is this amount, which is 5.4%. Not that. Yeah. So we have to add this on, uh, calculator 0.909 plus 909 plus 0.9917, 0.9917, then 1.1269, 1.169, then plus into lakh, it is lakh, so it becomes plus 5 rupees, 5.4 rupees, last one. So minus how much we invested, it is 3 lakh, okay. So 2765, 2760, so we say 2766 would be your goal. You have got it, and we did approximately 12766. That's excellent work. So when I say it is 2766, okay, approximately against the correct answer. So you have made a mistake. So impulse, it is 357413. To 0.909. When 9917. Yeah, got it. Here I have made it. So 0.89 divided by it is 1.46, 146,419. But this is point, you can see that 4, which is 11.4641. 11.4641. Now if you take it, you get some value. The 0.6, 0.069. So here we remediate 0.069, 0.069. So now we have to add this. Okay, now the answer will be so 0.909 plus 0.9917 plus 1.126, 1269, 1.1269 plus 0.0697. There are making some respect to yes, calculation. Yeah, yeah, mm, yeah, 1.1 into 1.1 into 1.1. Yeah, it is right. So point B, 0.5, 1.46. Um, So this is 546. Maybe this is the thing. Yeah, now even 5, 4, 6, 4. I see this is something as 5, 4, 6. Mm, maybe it's fine. I'm not sure about that. Yeah. And then 0.909. Now I have 0.9917 plus 0.1269. 1.169. So yeah, I must be like it is 57401. 57401. Oh, 413 is okay. But unfortunately, due to the rounding of present value, which is perfectly normal in practice. Okay. So it's greater than one, greater than zero. So it thumbs up project accepted. Now, are ready to move on to yes. No. Okay, so now we'll start. Hi, it's fantastic. It sounds like you have got NPV down pat. And that's your step in understanding investment appraisal, the capital budgeting. Your understanding of NPU guides decision making is spot on. Adding value and increasing shareholder sales is exactly what we are aiming for. Now let's smoothly transition to internal rate of return, which is indeed a close cousin of NPV. We have already Define IRR as the discount rate that makes the NPV of a project and cash flow equal to zero. Why is IRR important in financial decision making and capital budgeting? Imagine a Rita manufacturing company has several potential projects, but they can only choose one or two due to limited funds. How do they decide which one is best? That's where IRR come in handy. So we have this three projects. I think two projects are there. Direct profitability indicator. While NPV gives you a dollar amount of calculated, IRR gives you a percentage return. Where NPV gives the absolute value, where their IRR gives you a percentage return. This percentage is often easier for managers and stakeholders to understand and compare, saying the project is expected to yield a 15% annual return might resonate more than this project has an NPV of $50,000 or rupees 50,000. Comparison tool IRR allows for easy comparison of projects of different sizes or different initial investment. A project with a higher IRR is generally considered more desirable, assuming other factors are equal, because it promises a higher rate of return on the capital invested. Hurdle rate or cost of capital benchmark. Companies typically have minimum acceptable rate of return they require from any investment, known as hurdle rate or cost of capital. If a project's IRR is higher than the hurdle rate, it's generally considered acceptable. If it's lower, the project might not be worth pursuing. It's like asking, is this money tree going to grow faster than the interest we could earn by just putting our money in a saving account, or faster than the cost of borrowing money for the project? So, in essence, helps businesses quickly evaluate uh, and rank potential investment based on their expected rate of return, making it a critical tool in strategic financial planning and capital allocation. Does that help clarify IRR is such a vital tool in a financial world? And would you like to try a little experiment to solidify the concept? Yes, let's solidify the concept. Great. Let's do a quick thought experiment to tie this all together. Imagine Jeta Manufacturing Limited is considering two new projects. Project A requires an initial investment of rupees 1 lakh and has an IRR of rupees 18%. And Project B requires an initial investment of rupees 5 lakh and has an IRR of 20%. Data's minimum acceptable return hurdle rate is 12%. So 18% IRR also 0%. So we will take second project. Yes, this one 10 lakh rupees over for 1 million investment. I'm getting 18%. So I have to take mixed of wheat. So for example, if I take 25%, so average is 1 million and below 18%, 5 lakh, 25%, total 18 lakh, 15 lakh, 18%, 5 lakh, 25%, is 10 lakh, 18%, and 10 lakh, 12.5%, and 15 lakh. So can I say 10 lakh, 10 lakh into 18 plus 12.5 divided by 15 lakh. Average rate is 2 by 3, so it is 12.5 divided by into 2 by 3, that is 20, 30, 30.5 into 2 by 3, that is 60, 61 by 3. So it is 2, 20, 20.30%. So I could not take a mixed percentage of 20.33%. I could not take 20%. So if it 5 lakh, 5 lakh, 5 lakh we getting 35% of so can I see one fourth? So one fourth is 1.25, 1.25 lakh written. I am getting on 5 lakh. So on 10 lakh, I am getting maybe, 2.5 lakh. Yeah, question to understand. So based on your discussion, on which project or project would Jita Manufacturing Limited likely to consider? So both it could not consider and 18% as a written mode. So simply projected at this time, yes, Jita can go with projected as the return is more. So definitely on the right track with Project A, that's a good start. Project A with IRR 18% is indeed a strong candidate. But why would Cheetah Manufacturing Limited like consider pursuing it? And what about Project B? Remember, we are looking at our IRR related to Cheetah's hurdle rate. Think back to the discussion about the hurdle rate. How does the IRR of each project compare to Cheetah? Is Cheetah's 20% hurdle rate? Which projects are higher than this minimum acceptable rate? If you think it's a project B, in case of higher, it's project B. But in absolute term, it's not. So you are getting closer by focusing on project B. It's true that project B with its 25% IRR looks very attractive. But let's put all together the hurdle rate of data minimum acceptable return is 12%. So for a project to be considered, its IRR must be greater than or equal to this hurdle rate. So project E has 18%, it's 18%, greater than 12%. So both project, considering both project, which one make this criteria? Why would Cheetah pursue them? We're doing great, just a little more connection needed to fully nail it. So it can go with both projects. You have got it now. Cheetah Manufacturing Limited would likely consider pursuing both Project A and Project B because the mix also will become 20%. So we don't need to calculate mix also. Those projects which are doing more IRR are acceptable. Thumbs up. Both project promise a return that exceeds the company's required rate, that is other rate, meaning they are both potentially value-adding investment. Great job connecting the dots. This demonstrates a solid understanding of why IRR is so important in evaluating investment opportunities. Do you have any question about the interpretation, or are you ready to move on to the fascinating part, how we actually calculate IRR more? Fantastic. Let's tackle the calculation of IRR. This is where it gets a little bit more mathematical, but don't worry, we will break it down as we discuss IRR. is the discount rate that makes the net present value of a project's cash flow equal to zero. This means we are essentially solving for R in the following NPV formula when NPV is set to zero. So here we can see the formula is NPV summation of CFT by 1 plus R 1 plus IRR raised to power T, where T is from 0 to N, okay, is equal to 0. So where there is NPV is equal to 0, that is, so here CFT is equal to cash flow at time. This includes your initial investment, which is usually a negative cash flow at time 0. IRR is equal to internal rate of return, the rate we are trying to find. T is equal to time period, 0 for the initial investment, 1 for next, and so on. N is equal to total number of periods. Let's look at simple example to illustrate how this formula is set up. Imagine Jita Manufacturing Limited is considering a small project with the following cash flows. That is, initial investment is 10 lakh, but next because it's an outflow, and cash flow year one it is 6,000, and cash flow in second year 7,000. So to find IRR, we would set up the equation. The equation is simple and what you have to do is so you have invested 10,000. Okay. So in 6,000 we have receiving the first year, and 7,000 we are receiving second. Interest rate we have calculated. This is okay. So can I say 6,000 plus 1 plus 1, 7,000 plus 1 plus R square equal to 10,000. Now, so this is my equation. Now, here's the fun and sometimes tricky part. Solving the IRR in this equation, unlike NPV, where you plug in a given discount rate, finding IRR often requires trial and error, or more commonly in the real world using financial calculators or spreadsheet software like Excel's IRR function. This is because it's a polynomial equation that can be difficult to solve algebraically by hand, especially with many cash flow periods. The goal is to find IRR value that makes the right side of the equation equal to 0. The seeing the formula, how simple example is set up, help you visualize the calculation process, even if we don't manually solve it right now. So, or do you have any questions about components of the formula? No. Sorry. Perfect. Since you are comfortable with the setup, let's look at another simple example, this time to illustrate how we would approach finding the IRR using trial and error method, even if we won't get into the nitty-gritty of the full manual calculation. This will help reinforce the concept of it being the discount rate where NPV is equal to 0. So now, a project requires an initial investment of rupees 1 lakh today, 1,000 today, and is expected to generate a single cash inflow of rupees 1,210 at the end of year 2. So we want to find IRR. So for single equation, you can find out. So if you are doing this manually, we would be using different discount rates values. Two discount rates should be there. One is 5% and another. So let's see what is it. Let's for there should be two because it's a quadratic equation. So let's try an IRR of 5%. Here we are doing trial and error method. So with 5%, the NPV is positive 97.50. Our assumption is too low. We need NPV is equal to zero, and it is too low. So we have to increase it. So we need a higher discount rate to bring the NPV closer to zero. So we take 10%, and when you take 10%, your NPV becomes zero. So when we use 10%, our discount rate, the NPV is exactly zero. So therefore, IRR of this for this project is 10%. So this is simple example shows that the core idea is to find that the specific discount rate that balances the initial outlay with the present value of the future inflows. So while real world problems often have many cash flows and require software, the underlying principle of finding the rate where NPV equals zero remains the same. Thus, seeing this step-by-step trial and error process for very simple case help clarify how IRR is the specific rate that zeroes out the NPV. Would you like to try a similar, very simple setup, no calculation, just the setup to make sure you have got the concept? Or are you ready to move on? So move on. Move on, move on. Alright. Excellent. You are making great progress. You are making great progress. Now that we understand what IRR and IR is and how it's conceptually calculated, let's dive into the practical side. How do we interpret IRR and use it for making decisions? So this brings us to Cheetah Manufacturing Limited and their investment choices. The core of interpreting IRR lies in comparing it to the company's cost of capital, also known as hurdle rate or required rate of return. The cost of capital represents the minimum rate of return a company must earn on investment to satisfy its investors. Thinks of it as the cost of getting the money needed for the project. Here's the IRR decision rule. If IRR is greater than cost of capital, uh, I think we have done this now. Yeah, but does this decision rule make clear sense? Would you like a quick scenario to test your understanding and the concept of accept or reject the project based on IRR? Oh, yeah. Oh, no problem. Since the decision rule is clear, now let's look at the flip side of the coin, the advantage and disadvantage of using IRR. No tool is perfect, and understanding its limitation is just as important as knowing its strength. So advantages of IRR are intuitive and easy to understand as we discuss. A percentage rate of return is very easy for managers and stakeholders to grasp and communicate. It feels like a genuine return on investment. Considers time value of money, just like NPV, IRR properly accounts for the time value of money by discounting future cash flows. This is a crucial for accurate financial analysis. No need for a predetermined discount rate initially. When calculating IRR, you don't need to know the cost of capital beforehand. You are solving the project's inherent rate of return. Now, you do need the cost of capital to make the decision once you have calculated the IRR. Disadvantages of IRR, multiple IRRs or no IRR. This is a big one. For projects with unconventional cash flow patterns where cash flows switch from positive to negative more than once, like an initial investment, then positive returns, and then another large negative outflow or decommissioning. There might be multiple IRR or even no real IRR at all. This makes interpretation very confusing or impossible. Analogy, imagine trying to find the single average speed for a car trip where you drove forward, then backward, then forward again, and several times. It gets messy. So reinvestment rate assumption. Second is reinvestment rate assumption. IRR assumes that the project's interim cash flows, the money you get back before the project ends, can be reinvested at the IRR itself. This is often an unrealistic assumption, especially if the calculated IRR is very high. NPV, or other hand, assumes reinvestment at the cost of capital, which is generally more realistic. Analogy: if your money tree gives you fruit, IRR assumes you can plant those fruit and get a new mini money trees that also grow at the same fantastic rate. Often you might only be able to reinvest at lower, more typical market rate. Scale problem. When comparing two mutually exclusive projects, meaning you can only choose one, not both, then the project with higher rate of return isn't always the best choice. A smaller project might have a high IRR, but a larger project with a slightly lower IRR might actually add more total value to the company. Example, Project X has IRR of 30% and NPV of rupees 10,000. And Project Y has a IRR of 20% and NPV of 50,000. So if you can only choose one, then Project Y is better because it adds more absolute value even with a lower percentage return. This is why NPV is generally preferred for mutually exclusive projects. So while IRR is intuitive and popular, it has significant limitation, especially when dealing with complex projects and choosing between alternatives. This is why financial analysis often use both IRR and NPV together to get a complete picture. Thus, understanding these pros and cons, particularly the issues with multiple IRRs and reinvestment assumption, clarify why IRR isn't always the sole decision maker. Yeah, yes, excellent. Excellent. It's great that you have grasping both the power and the pitfalls of IRR. That leads us perfectly into our next section, the relationship between IRR and NPV, and when you might prefer one over the other. Here we'll see. As you have already seen, IRR and NPV are inextricably linked. The IRR is the discount rate at which a project's NPV is zero, and this means they will generally lead to the same accept or reject decision for independent projects. Projects where the decision to accept one doesn't affect the decision to accept or reject another. Here's the core relationship. If a project's IRR is greater than the cost of capital, its NPV it will be positive. If a project's IRR is less than cost of capitals, its NPV will be negative. If project's IRR equals to the cost of capital, its NPV will be zero. You can actually plot a project's NPV at different discount rates and you will get what's called an NPV profile. The point where the This profile crosses the x-axis where the NPV is equal to 0 is precisely the IRR. When is it better to use one or the other? Generally, NPV is considered the theoretically superior method for capital budgeting decisions, especially when choosing between mutually exclusive projects. NPV is better when comparing mutually exclusive projects as we just discussed. NPV directly measures the absolute increase in wealth for the company, and a project with a highly higher NPV, even if it has a lower IRR, adds more total value. Imagine Cheetah Manufacturing has to choose between two machines. One costs more but generates significantly higher total dollar value over its life. NPV would capture this better. Unconventional cash flows. When cash flows switch signs multiple times, IRR can give misleading results. Multiple IRRs, NPV doesn't suffer from this problem. It will always give a single clear dollar value, rupee value. Different project sizes. NPV is better at comparing projects of very different scales because it provides a dollar value. A small project with high IRR might not add as much value as large projects with a more modest IRR. IRR is often preferred for simplicity and intuition. Managers often prefer to talk in percentage. This project yields 50% rather than absolute dollar figure or absolute rupee figures. Even if the latter is more theoretically sound, it's often easier for non-finance professional to grasp. Preliminary screening. IRR can be a quick initial screening tool if a project's IRR is clearly below the hurdle rate. You don't even need to calculate NPV to know it's probably not worth considering. In practice, many companies use both. They might calculate IRR first for a quick intuitive sense and then use NPV as the ultimate decision criteria, especially for complex and mutually exclusive projects. Does this explanation of their relationship and when to use each make sense? We can discuss scenario where one might be preferred over the other. If you would like, we'll discuss the scenario. Okay. Yeah. Great. Let's solidify this understanding with a scenario. This will help illustrate why choosing the right tool, IRR or NPV, IRR versus NPV is crucial, especially for Jita Manufacturing Limited. Jita Manufacturing Limited is considering two mutually exclusive production lines. They can only choose one production line X, a production line Y. Arrow 2030, BV initial investment 5 lakh, 2 lakh, PV 5 lakh, million, 5 million, 2 million, then PV 1.5 million, and for URI, which is 1 million. Okay, so both projects have IRR well above Jita's cost of capital. And both projects IRR is about hurdle rate. Okay, so wants to maximize the absolute increase in shareholders' faith. Which production line should they choose and why? So we'll see which production line they should prefer. So as I say, NPV is 1 lakh. Uh, return on return. So the project line yet should be chosen. But as per IRR, they can choose both, but here we have to choose only one. So we will choose line with money. This is a better choice for Jita manufacturing in this scenario. But could you tell me why? Why? What was the key factor that led you to choose absolute value? No, this 50 Hello. Depends 5 lakhs for this both by 5 lakh rupees. Okay. So even though the production line was higher IRR, when you when you can only choose the one project, the goal is to maximize the total value added. The NPU directly measures this value, making it the superior metric for decision making with mutually exclusive projects. So you have demonstrated a fantastic understanding of IRR, NPV, and their relationship, and when to use each. So this is really important concept in finance. So we have now covered all the major topics in our learning plan of IRR. Do you have any further questions? So we have learned capital budgeting also. Let's continue our earlier plan. 30 on capital budgeting. So we will see now. We are done with cost. We have completed cost of capital structure, financial. Now we will go with uh, working capital management. And before that, okay, we will go with working capital. Excellent choice. Working capital management is a crucial part of financial management, focusing on the short-term financial health and efficiency of a business. It's all about ensuring a company has enough cash flow to meet its immediate obligations and continue its day-to-day operations smoothly. Think of it like managing your daily household budget. You need enough money for grocery bills and unexpected repairs without having too much sitting idle. Or a business, it involves managing current assets like cash, inventory, accounts receivable, and current liabilities like payable and short-term loan. Let's set up learning plan to explore working capital management. So we will see introduction to working capital, management of current assets, management of current liabilities, working capital management strategies in our next webinar. Thank you. Signing off.